This is Matthew Cratter from Trader University, and today I want to answer the question, is Bitcoin's price being suppressed like gold? This is something we've been talking about for a couple days. Yesterday we discussed how Bitcoin IOUs and what you might call paper Bitcoin artificially increase the apparent supply of Bitcoin, and I'm putting that in quotation marks because there's paper Bitcoin and then there's real Bitcoin. This production of paper Bitcoin can lead to some short-term price suppression, but it carries with it the future promise of a massive Bitcoin short price squeeze, the kind of thing we saw in GameStop and AMC and other stocks, meme stocks like that earlier this year. This will be very good for those who actually hold their own private keys and do not have a Bitcoin IOU from their exchange or from an app or something like that. If you want to hear more about that, I'll put a link in the description notes below to this video, the dangers of paper Bitcoin. There's a related question which I promised to talk about. It's a question I get a lot. Here's a version of it from Chris Cubit. I blew up the question, the comment here. Are you concerned that the paper futures will be used to manage the price of Bitcoin? The enemies of Bitcoin specialize in this sort of activity. GATA has been exposing them for years. I think he meant the enemies of gold here. The enemies of gold specialize in this sort of activity. GATA has been exposing them for years to no avail in the precious metals market. So here's the background, what Chris is referring to if you're not aware of this. If you're a gold bug, you're quite aware of this. The background is this. The gold has historically functioned as a canary in the coal mine, or as what you might think of as like a barometer or thermometer, and shows you the temperature in the room, how hot the economy is getting, how much damage the central bankers are causing to the fiat currency. So for this reason, over time, especially when the U.S. left the gold standard, and after it left the gold standard in 1971, gold needed to be neutered by central bankers so that it would not display very clearly their bad activities. And indeed, it has been neutered. It's failed, especially over the past decade, to be a good hedge against inflation and Fed money printing. And this is really striking if you think about it, because this is gold's main use case, is inflation hedge, a way of hedging against currency devaluation. Over the past 10 years, though, the price of everything has gone up. Everything, that is, except for gold. Even cans of Campbell's tomato soup would have been a better inflation hedge over the past 10 years than gold has been. Gold has really gone nowhere for a decade. And I believe that this is because central bankers have almost certainly colluded with bullion banks to systematically suppress the price of gold over the past, certainly the past decade, probably since 1971, using sales of gold, gold swaps, gold leases, and then the sale of gold futures contracts. In other words, shorting gold using futures. There's a lot of, this is a very deep rabbit hole. I haven't gone that far down it. You can read more about it at the GATA website, which is what Mike was referring to. It stands for the Gold Antitrust Action Committee. They've been trying to sue the government and do various things like this over the past few decades, and I don't think they've met that much success. But they do have very interesting material, and I think they're quite smart. There's an interview here in Forbes that one of the folks from GATA gave, and part of it I wanted to highlight right here. I'll link to the whole thing in the description notes below. Are there any public records that point to gold suppression by governments? And then he cites a former president of the Netherlands Central Bank, who also served as president of the BIS, the Bank of International Settlements, which is one of the groups, one of these big, nasty institutions like the World Economic Forum that are in charge of so many things. But anyway, the former president of this wrote in his memoirs that the gold price has always been suppressed at the behest of the United States through international action. You can read the whole interview below. It's quite a damning interview, actually. The bad guy in a lot of this, you'll see the name come up if you go down the rabbit hole, is the LBMA, the London Bullion Market Association, which is this based in London. They have a lot of the gold stored there, or supposedly stored there, and it's this international trade association that's part of this suppression, plays a part in the suppression of gold. And so you have GATA versus LBMA, you have the gold bugs versus the central banks, etc. But not even GATA believes that you can suppress the price of gold using just gold futures and naked gold shorts. Again, the question here is Bitcoin being suppressed by futures contracts? And so we have to examine the question, has gold been actually suppressed by gold futures contracts, shorting gold in other words. GATA does not believe that you can do this just with gold futures. And GATA is really the expert in this sort of thing. And this is what their whole purpose of their organization is. But GATA believes that you need to own a lot of physical gold as well if you're going to be effective at suppressing the price of gold like a central bank would want to do. So basically, if you own a lot of physical gold, then you can always dump some onto the market to stop its momentum, to stop gold in its tracks whenever it begins to rally. And here's another highlight from that Forbes interview right here. That seemed to be a paradox to GATA some years ago. And the paradox here was, why does the U.S. Treasury, why do global central banks who own a lot of gold want to suppress the price? They're really shooting themselves in the foot. Of course, the U.S. dollar is much bigger than gold, so it does make sense. But this is the paradox that they don't have to worry about anymore, because they say, GATA says, in order to suppress the price of gold, you need a certain amount of inventory to knock the market down. You can't do it entirely through naked shorting that they do in the futures market. Again, this is GATA speaking. I'm not an expert in this. You always need to be bleeding a certain amount of the metal into the market to maintain the appearance of a gold market. You can't just be trading paper all the time. It's not enough. So this is very significant when it comes to applying these same principles to Bitcoin, because central banks own a lot of gold, governments own a lot of gold, but governments and central banks do not own large inventories of Bitcoin. In fact, most of them probably own 0 Bitcoin right now. So what they can do, they can play around with the futures, especially the cash settled futures. The big ones are the ones that trade in Chicago on the Merc, the CME. They can short CME cash settled Bitcoin futures and try to drive down the price of Bitcoin futures. And then there's this link between the spot price, the cash price of real Bitcoin, and then the futures, which is another form of paper Bitcoin. And so they can try to suppress the market this way. They can also print up a lot of dollars to fund their margin positions, to post margin at the futures exchange. But even GATA admits that this is not what has been keeping down the price of gold. And so the way they do it with gold, there's a lot of gold, as we mentioned, the LBMA warehouse, and they also almost certainly do fake accounting to balance their books there. They're able to play around with allocated and unallocated gold inventories to allow more naked shorts than would otherwise be allowed. But even with all of this, you can't do this with Bitcoin simply because there's no LBMA for Bitcoin. There are not, central banks do not have warehouses full of Bitcoin. There's nothing like a Bitcoin Fort Knox where supposedly the U.S.'s gold is stored. Now, there will never need to be the centralization of Bitcoin either. And the reason for this, Satoshi was very smart. He saw what had happened to gold, how it had become captured by central banks and governments. And it was very easy to capture gold because physical gold is very heavy. It's difficult to move around and store, which leads to a lot of centralization. It makes a lot of sense from the perspective of energy and security to keep a lot of gold in one place and then to guard that place really carefully. And this is how Fort Knox functions as well. But this was ultimately this property of gold led to the centralization of gold, which led to the capture of gold and thus the end of the gold standard. We had the government capture of gold in 1933 in the U.S. when President Roosevelt confiscated all the gold held in U.S. banks. This was Executive Order 6102, and then he put the gold in Fort Knox. This also made it really easy for the U.S. to abandon the gold standard in 1971. Now, we've been going through a period the last couple of years where Bitcoin is being actively centralized on exchanges like Coinbase. And so we don't want this to happen to Bitcoin in the way it happened to gold, this sort of centralization of Bitcoin on the exchanges. And there's no reason for this. Bitcoin does not need to be centralized to be able to be stored. It's very easy to store in small amounts and also move around in large amounts. So this is why if we don't want Bitcoin to become centralized on the exchanges and everyone just leaving their Bitcoin in their apps or on the exchanges on Coinbase or Kraken or Binance, it's very important, as we've been talking about for the past few months, to withdraw your Bitcoin from exchanges and hold it on a hardware wallet yourself. Because this sort of centralization of Bitcoin on the exchanges, it's not just a threat to your Bitcoin, which could be lost or hacked on the exchange, but it's also a threat to the whole Bitcoin ecosystem. I talk about how to withdraw your Bitcoin, how to buy it on Strike or Coinbase, and then withdraw it and hold it on a hardware wallet in this video here, which I will link to below. And while you're here, if you wouldn't mind giving me a subscribe and a like, and share this video with a few friends. It's especially important to subscribe if you watch my videos all the time and still haven't subscribed. We want to help the YouTube algorithm get these videos out to as many people as possible. Now, fortunately, most serious Bitcoiners, and especially the OGs, hold their own private keys. They don't leave their Bitcoin on exchanges, and they don't leave their Bitcoin with other third-party custodians. And this is in contrast even now, where most Americans, as far as I can tell, and most people in other countries who hold serious amounts of gold. It's one thing to hold a couple $1,000s of gold, but certainly if you're going to hold hundreds of thousands of dollars worth of gold or millions of dollars worth of gold, the most common way of holding gold, I believe, is still for the large holders to hold a gold ETF like GLD, which is a form of paper gold, or to store your gold at a bank or in a vault, in a third-party vault. And Bitcoin has this advantage that it doesn't need to be stored in this way. So here's another question, a related question. Is the supply cap of Bitcoin actually higher than 21 million coins? Because there's paper Bitcoin. We talked about some forms of paper Bitcoin like Robinhood Bitcoin in yesterday's video, which I told you about. But the question is are these futures contracts on Bitcoin, especially cash settled futures contracts, is this another form of paper Bitcoin? And I would say probably not. This is one reason that GATA realized that you need physical gold in order to suppress the price of gold. You need actual inventories to drip into the market, and you can't just do it with futures. And I think the same thing is true for Bitcoin futures as well, simply because of the way that futures work. The way futures work is for every seller of a futures contract, there's always a buyer. It's a zero-sum game before commissions. And so an analogy would be their futures on corn and wheat. But this doesn't mean that the actual supply of corn or wheat is unlimited. If so, we should just create a lot more corn futures, and that way no one in the world will ever starve again. But this obviously doesn't make any sense. And if the open interest of futures contracts on corn or wheat goes up, it doesn't mean that the supply of corn and wheat goes up. Now, you might argue that corn and wheat futures are physically settled and Bitcoin futures, for the most part, are cash settled. That being said, most people don't hold Bitcoin to the expiration of the contract or hold it to delivery. And it is, if you're long or short a Bitcoin futures contract, it's being marked to market using cash from day to day, whether it's a physically settled Bitcoin futures contract or a cash settled. You still have that mark to market and the cash flowing back and forth every single day. So I don't think that that futures contracts increase the supply of Bitcoin in the same way that paper IOUs, say from Robinhood or a company like that, might increase the artificial supply of Bitcoin. And GATA would seem to back me up here, saying that you can't just suppress the price of gold using gold futures. That it just doesn't work. If gold spikes, as we said, central banks can step in and sell some of their physical gold. But if the price of Bitcoin spikes, central banks don't have any Bitcoin, or at least not significant amounts of Bitcoin, to dump on the market. If one central bank tries to short Bitcoin, it might find itself in a similar position to those hedge funds earlier this year that were short GameStop when they were squeezed. They were squeezed by Wall Street bets, and we saw the amazing price spikes we got there. So something similar could happen to groups and institutions that short Bitcoin. And this could actually become a form of warfare, online warfare, where you get Bitcoiners and central banks who own Bitcoin could try to engineer a massive short squeeze and blow up the central banks that are short Bitcoin. This would really be something to see. Currently, the paper Bitcoin market is much smaller than the real Bitcoin market. And by this, I'm including futures contracts and also Bitcoin IOUs, like Robinhood's IOUs, for example. By contrast, the paper gold market is something like 100x the physical gold market. This is what I've been reading. If you're a gold bug and you know more about this than me, please correct me if I'm wrong. But if we can work to educate people not to buy paper Bitcoin, in other words, paper Bitcoin IOUs, and buy real Bitcoin instead, withdraw it from the exchanges, hold it on a hardware wallet, then we can help to stop the paper Bitcoin market from getting as big as the paper gold market has gotten. Even such, the paper gold market even being 100x the size of the physical market, GATA still doesn't believe that this paper market can, in itself, keep down the price of gold. But we don't want to find out the hard way with Bitcoin. A lot of people will mention that the coincidence or the correlation that Bitcoin, its parabolic rally in the fourth quarter of 2017, really came to a close at the same time that Bitcoin futures were first introduced. They were also introduced in December 2017 on the Merc, and they started trading. And there's a lot of debate about whether these were used to suppress the price of Bitcoin. Maybe they were, maybe they were not. But it's really important to realize that Bitcoin peaked at around 20,000 in December 2017, and yet Bitcoin futures were not able to keep Bitcoin's price below this 20,000 all-time high forever. They couldn't even keep it below that for more than 3 years. So by December of 2020, by last year, Bitcoin had surpassed the previous all-time high. And today, as I'm recording this in December of 2021, Bitcoin is trading about 2.5 times higher than that previous all-time high of 20,000. So if futures are meant to keep down the price of Bitcoin, they are failing because we've been hitting new all-time highs for much of this year. There's also the game theory of this. If one central bank drives down the price of Bitcoin, it makes it more affordable for people like you and me to accumulate more real Bitcoin. And it also makes it more affordable, as we said, for other central banks to buy Bitcoin. And so if the Fed tries to do something like this and suppress the price of Bitcoin, it could actually be enabling the Bank of China or the central bank in Russia to accumulate cheap, real Bitcoin, which would be a huge security risk to the U.S. So countries that try to manipulate the price of Bitcoin need to be very conscious of this, that they may be helping their enemies. So to summarize, Bitcoin is much easier to transport, to store, to assay, or verify than gold is, which renders paper Bitcoin much less necessary than paper gold. There's no reason for a paper Bitcoin market to arise around Bitcoin. There's no physical limitation or inherent reason that Bitcoin needs to become massively centralized like gold has become. And as we said, the game theory suggests that it's actually much better to be the first central bank to buy Bitcoin rather than the first one to short it. If your central bank is shorting Bitcoin while another central bank is trying to corner the whole Bitcoin supply with freshly printed money, your central bank will be on the losing side of this trade. And so I want the Federal Reserve, if anyone from there is listening to this, to be very aware of this, that you're actually shooting the U.S. in the foot if you try to play these games. If Bitcoin price suppression is actually happening in any form, it's actually a great thing for you and me because it allows us to continue to dollar cost average, to DCA, and to buy more real Bitcoin for the same amount of fiat money. Even if worse comes to worse and Bitcoin is suppressed and successfully suppressed so that it stays at the market cap of suppressed gold. Gold currently has a market cap of roughly 10 trillion. This would mean that if the price of Bitcoin is suppressed, it would cap out at around $500,000 per Bitcoin. And so this isn't the worst thing in the world. It's still 10x from here. And this is assuming the authorities are successful in suppressing the price of Bitcoin as they have been in suppressing the price of gold. I don't think they can do it, but if they can, maybe we top out at around $500,000 per Bitcoin, which is still a massive market cap for Bitcoin at 10 trillion. I'll be taking the next few days off to spend some time with the family, so no video until Monday, December 27th. But if you want more material to watch this week, you can check out my paid courses, Trader University Premium. I'll put a link in the description notes below. Also, if you're looking for that last-minute gift, you want to give a digital gift, consider giving a 30-day subscription to Trader University Premium, where you can check out all my trading courses, investing courses, and especially my course on Bitcoin, the ultimate guide to Bitcoin. If you decide to do this, make sure you use the discount code YT99, as in YouTube 99, in order to get the best price, which is just $99 to get access to all 16 courses for 30 days. I'll put a link in the description notes below where you can check out each of these individual courses. And then at the top here, there's the ultimate guide to Bitcoin. I hope all of you have a wonderful holiday season. May Santa fill all of your stockings with real Bitcoin, not paper Bitcoin or Bitcoin IOUs, and certainly not coal like XRP or Cardano or other altcoins. So I want to wish you all a very Merry Christmas, and I'll see you in a few days from now.